I'm Charlotte McLeod with the Investing News Network, and you're watching part 2 of my latest interview with E.B. Tucker, director at Metallo Royalty and Streaming. Keep watching to learn why he thinks royalty and streaming companies are a good investment even in today's difficult market, and what Metallo Royalty and Streaming is up to right now. And maybe this is a good time to transition into Metallo, what's going on there. I have a question about royalty and streaming companies. We always hear that they're a good place to be, more safe than other mining stocks and things like that. I started to worry a little bit when all the mines around the world started going offline due to the coronavirus and things like that. So is it still a safe place to be right now, given those circumstances? I know we have some mines that have come back online. It's a little less precarious right now, but what's your take on that?
So I'm going to tell you a secret that is going to enrage all the message board people that are chatting about stocks on all the favorite message boards, CEO, CA, and all these things. Cash flow in the royalty business is of very little importance. The royalty business is a unique and amazing business, because what happens is you get leverage, like Archimedes, talked about the concept of leverage. You can move anything if you have a long enough piece of equipment to do it. Gold Royalty Company is a leverage tool a million miles long. I mean, you've got 300, 400, 500,000 ounces, Franco and these companies, millions of ounces buried in the ground. You know where they all are. You can see in the annual where everything is. You know exactly where it is. Everything's proven. It's 43-101 proven, sitting there. And every time the price of gold moves, then the value of those ounces in the ground goes up. And sometimes it goes up quite dramatically, because the royalty company pays no money to pull that gold out of the ground. Likewise, if Pan American has to pause production in a country because of the coronavirus, the royalty company doesn't have to contribute to the care and maintenance shutdown, to the temporary getting the workers out, or some of the companies in Quebec have to fly them in private transport now. It is very expensive. The royalty company doesn't worry about that. The royalty company says, what's the price of gold times how many ounces of gold are covered by our royalty claims? And so when people look at the royalty companies, there's a way to value them that takes this into account. The experts in the business know this, and the message board people don't know this. So they look at a PE ratio and all these things that you learn about when you read a basic finance book. But the way you value them is on the net asset value. So you take the price divided by the net asset value. That's P/NAV. Scotiabank puts out a brilliant report about this on the first day of every month. It takes all the royalty companies and it values them based on net asset value. Because when you look at the value based on revenue, like your question, what happens is you don't account for the ounces that come out. It's kind of like if you never ordered inventory at your shoe store. You sell a pair of shoes, you don't order any more, you don't account for the fact that you have one less pair of shoes. You just burned it up. So you don't have any accounting for that loss of inventory. So when you look at the net asset value price, what that does is it accounts for everything in the ground. Now, further, all these companies are drilling, and coming out with results to say we found another 1,000 ounces or another 100,000 ounces or whatever. And the royalty company has 1% of that. So the net asset value model keeps growing. And when everyone looks at the price, they say, well, what if you don't get any cash flow for 2 months? Look, I'm not going to say that it's irrelevant, because that would be somewhat flippant, but it has such a lower amount of relevance for a royalty company than it does for a mining company, because the mining company has tremendous operating costs, tremendous. And the royalty company has stock exchange, listing, auditing, office, water cooler. I mean, you start adding these things up, there's not that many expenses, right? Whereas the Barrick Gold or someone has tremendous expenses in even just safety training. I mean, it's you start adding all these things up, and it's a lot different. And so when people look at royalties, I think that they would be wise to say, I want to know what's in the ground, how many royalty claims do you have, how much do they cover, how many ounces are proven, and who are the people that are the miners. Because like if you have an Agnico claim, Agnico is drilling, and coming out and saying, we expanded the deposit, we found this, we did that. And you have to go to Agnico's report. You see, so this is the real way to own. Now, what I'm telling you is going to be known one day. It's going to one day, years from now, when gold is $4,000 or something, and Metal is gone from its current, 7.25 Canadian to, a much higher price. People will then know this because this will become a very popular way to invest in gold, because it doesn't deal with some of the headaches that come with mining. And so this will be, so what I'm telling you is something that in the future people will realize. But today, almost no one, I go to New York to meet with funds, I have to explain this, and they say, oh, okay, well, I guess that makes sense, because no one's ever looked at it. I mean, the whole royalty market cap of Franco and Royal and Wheaton and Mavericks and Metalla and Sandstorm, that's all the companies, by the way. It's a fraction the size of even a company like Chevron that is also tiny now after what's happened to oil. And the royalty companies is half that size. So, I mean, we're talking about just a seedling. And you see Franco at over $200 Canadian a share, an all-time high. I mean, you can see what's happening. And by the way, Franco trades at 3 times net asset value. Metalla trades at 1.4. The average is 1.6. So Franco is the leader. It's trading at almost double its peers. And what it tells you is that the other companies are likely to catch up, because Franco leads the pack.
Okay. Just briefly, tell me, what's your game plan as a royalty company moving forward this year? I know there's just an acquisition at Metalla. What's the plan?
A big acquisition. This acquisition was very strategic in some highly sought after land in Nevada, where Barrick operates one of its larger mines with Newmont, obviously, in the partnership that they have. And so if you look at the information that we put out, which I don't think people really look at this, it's a claim block that's just adjacent to that asset. So I mean, from a board level, that's exactly the kind of things that we want. I mean, Franco would not be Franco without Goldstrike, and Pierre and the guys will tell you that. I mean, it was an asset that they paid $2 million for, and it's returned over $1 billion in cash flow since the late 80s when they bought it. And what happened is they ended up, this royalties on a beautiful section of trend, on a major gold mine. You can see it from Google satellite view. You can see the hole in the ground. So I mean, this is a serious asset. But my point is they paid $2 million for it, and it became something much larger. And Royal Gold had the same thing, right, at Cortez, which is about an hour and a half south of where Franco's asset. We're talking about this is a tiny area. So Metalla is just next to the area where Royal has its claims. And so the reason why I tell you that is that what we don't do is finance junior mining companies into production. That's what we don't do. And people always get this mixed up. If you look at our royalties, we have 48 royalties. We bought royalties on Agnico projects and Pan American and Newmont, Goldcorp, and all these different household names. And people say, well, how did you do that? I mean, clearly, Newmont doesn't need money. Yeah, obviously. But someone had that royalty, and our stock is up 70% per year average for 3.5 years. And so we've been able to go to them and say, hey, look, why don't you sell that royalty to us, and we'll give you stock, and you can be kind of part of this 48 goes to 50, goes to 60, goes to 70 royalties. I mean, how big can it be? I don't know, because of course someday you run into growth limits. I mean, this is not the kind of thing you can do for 50 years. It's like you do run into a point where the business model has to evolve, but that day is not today. And so you do 16, 17 transactions like we've done, and you see that each time we do a transaction, a lot of people say, well, they issued stock to do that transaction. Yeah, and the stock went up. I mean, because what we're not going to do is open up the checkbook and go to weaker companies and give them a bunch of money, and so that they can dig a hole in the ground, and then the hole floods, and then they don't produce anything. That's what we're not going to do. So Metalla is a very unique business, in this, we call this the third party royalty market, because you're not taking a direct initiation of a royalty. You're picking up royalties from an owner that has a royalty on something else. And so we're going to continue to do this as long as we can. It's worked out really well so far. I mean, we started at $1.20 Canadian, and it's 7.25 today. And so the average shareholder was able to buy that and hasn't done anything except for collect dividends, and sit and keep up with the news releases. I mean, it's been, and it's also not an overnight sensation. I mean, it's not like a mining stock that puts a hole in the ground and finds, a Brinks truck buried in the dirt somewhere. It's not like that. This is a business, and it's a business that you build a pipeline of potential acquisitions, and you put a lot of diligent effort into making sure that they're things that you want at the right price. And then you have to be confident enough to let things pass when they're too expensive. Can't tell you how many times we've said, we'll give you 10 million for that. Somebody gave 15, and people laugh at us. Oh, you guys, you don't understand. And then a year later, turns out it was worth 10. So I mean, we're just not going to do that. And that's the company's leadership is, Brett Heath is one of the most disciplined guys I've ever met in the business. And he ultimately will be a mining Hall of Fame legend. I mean, there's really no one like him. And I think even some of the guys running the biggest companies recognize that now.
Okay, that's great. I think we can wrap it up there, unless there's anything else you want to leave investors with today. Maybe let us know when we can expect your book that's coming out.
The target date is May 31st. So assuming we don't have any sort of problems with finishing, there's all this stuff to do. I never knew the cover design and all these different, getting all the barcodes and things that are kind of like, you don't think about these things, but the actual writing is wrapped up. And so we're trying to get that out by the 31st. So next time I see you, whether it's in person or on Zoom, hopefully we can tell people to look for that. But the book is going to be called Why Gold, Why Now? And it'll be on Amazon, Kindle, and audible.com right away. And then the print edition will follow.
Okay, perfect. Thank you so much. Once again, I'm Charlotte McLeod with the Investing News Network, and this is E.B. Tucker with Metalla Royalty and Streaming.
Thanks, Charlotte.
Thanks for watching part 2 of my interview with E.B. Tucker. If you missed part 1, where we talked about gold's recent price activity and where it could be headed next, make sure to click the link below.